It's auto, but okay. I'm just gonna go ahead and say C1. Okay. Let's see how it looks. So we gotta pull that up. Stand up, actually, steps. Two-side English, live stream, safety, my movement. You good, sir? Bueno. All right. Let's get started.
Okay, everyone. I would like to officially welcome you out to the Swan Capital Halftime Report. It's my pleasure to introduce you guys tonight, the founder and CEO of Swan Capital. Everyone, please, round of applause for Andrew McNair.
Great.
Thank you. Well, tonight and today, I should say, is a very special event that we do twice a year. And this event is so critical to us because there's a lot of noise out there. And I always like to joke, maybe I'm just happily ignorant, but I try to not watch and limit the news too much. And the reason why you can do the same, especially with the financial sector, is because we offer a monthly market recap every month, and we do this event twice a year. And if you don't ever catch this event, remember that if you can't catch it in person, we do this event live. So I want to thank every single one of you that's here in person, as well as those who are watching online. So today's event may seem like financial advice to you. My job as a speaker is trying to speak to each and every single one of you. But I'm not giving you personal financial advice. It would be impossible to cover everyone's situation because everyone in this room, everyone that I know individually has a different situation. So don't take any of it as personal financial advice, even though it may feel like personal financial advice. This event is really structured in 4 different chapters that we're going to take our time. We're not going to rush through it, and we're going to unpack these 4 different agenda items. The first thing we're going to talk about is where we are today. How did we get here in August 2024? Then we're going to progress, and we're going to talk about how did the market get here? What's underneath the economic hood that has taken us to this point in the market and in the economy? So we're going to talk about what's driving the market's performance. Then we're going to transition to what may lie ahead. I will pull out my crystal ball like I do every 6 months and share with you what I'm seeing and what I'm concerned about and what we're keeping a close eye on here at Swan Capital with our portfolio management team. And then lastly, probably what you should care about the most is what we're doing about it. How we're implementing strategies right now, and we have been implementing strategies over the last few weeks to prepare for what may lie ahead. So let's jump right in. Where are we today? If you look at the S&P 500, you can see that the S&P 500 has received a lot of bad news and a lot of good news, but has treated it as all good news. And it keeps on marching forward. And as you can see year to date, 14% here year to date. And we've had some really I would say stellar, pardon the pun, events. Like we were able to land a private sector company, Intuitive Machines out of Texas, was able to put us back on the moon, at which we haven't been to, none of our devices in 50 years. And so it's pretty incredible. We also narrowly almost got ourselves into another government shutdown earlier in the year. And as you can see, Putin, because he's so loved in his country and worldwide, he actually won the presidential election again with an 88% vote. Pretty impressive that everyone loves him so much. And then you have the Iranian strikes against Israel and how the market was concerned, rightfully so, with the geopolitical events. And here we are today, or getting closer to today, with the presidential debate with two seniors debating on live television how great their golf games are or not. So pretty great comical times to be an American. And then it takes us to this day in August. So we're going to unpack this really stellar year that we've had in the S&P 500 and in our portfolios. What we've seen is 31 all-time highs reached. What an incredible feat for the year to just continually march forward to 31 new all-time highs for the S&P 500. And a lot of families, I understand where you're sitting as a retiree who's 5 years into retirement, about to retire. You see all these all-time highs marching forward, and you think, maybe this is the time I go to cash. This is the time that I should be on the sidelines. And what we know statistically with momentum investing, actually all-time highs do have a tendency to cluster at times. Now, if you had a 20-year investment horizon, this would be a perfect time to have the majority of your money in the market to enjoy all of those returns. But that's not your chapter of life, of course. And I want to encourage you, and we've already heard some, I guess concerns in reviews one-on-one where clients are saying, hey, I have these roof accounts. Now, if you're not familiar with our terminology, roof accounts are market-related investments. Stocks, ETFs, mutual funds, things like that are considered roof accounts. Maybe we should bring some of our roof accounts down to the walls, or maybe we should move it down to the foundation. When we built your financial plan one-on-one, we planned for a period like this. We planned for a spring and a summer, and that's why we allocated very clearly how much we wanted in those roof accounts, expecting them to continue to grow. But that's also why we prepared for a market pullback with your wall account or your foundational account in case the market doesn't keep on marching forward. So that's just trying to instill some confidence into you that we can let our roof accounts continue to grow. And I'm going to talk about how we've tried to limit our downside as best as possible. Continuing on, this really will show you how overvalued the market has become, though. And there are 4 or 5 major, I would call them thermometers, that we track here at Swan Capital to make sure that we haven't lost sight of where the market is in valuations. A lot of times we can get caught in euphoria, irrational exuberance. And these 4 or 5 metrics that we look at, the yield curve, we look at the Shiller PE ratio, we look at a few other, including this Buffett indicator, the Buffett ratio. It goes by a few names, made famous obviously by Warren Buffett. It compares our country's GDP, so our country's output, the gross domestic product of our country, compared to our stock market. And what I want to show you here is you never want to see the stock market start to get over its skis, because every time it gets above 2 standard deviations, it's not a matter of years, but more like months or weeks before we see a major pullback. And so this is a red alert thermostat that we're looking at when the Buffett indicator is at 197%. And so this is why we've, over the last 12 weeks, been taking actions of getting prepared for a potential pullback. Now, does that guarantee, because of the past, that's what will happen in the future? Absolutely not. And that's why I have that first slide just before this one, talking about how we need to stay the course with our roof accounts, even when the market keeps on marching forward. So I do want to show you that we're keeping a close eye on the Buffett indicator, the Shiller PE ratio, among many others. If we look at, let's take our scope and look overseas, where I just came back, if you watched our monthly market recap from overseas. We also want to look at the discrepancy between our domestic market here compared to the international market. Now, sadly, the international market has underperformed for a long time, but there have been seasons, and there's seasonality between the discrepancy between domestic indices as well as international. And what we're seeing here, to translate this graph, is we're at record low discounts in international equities. And sadly, I see a lot of families that come to us and they have no international exposure. Maybe they have a TSP with no iFund in it at all. And so I'm one of those that I believe we should have a 10 to 15% exposure to international securities because of this extremely discounted situation. Now, we're not going to load up on emerging markets. We're not going to go too heavy and get out of balance or change grandma's recipe with our portfolios to add in international markets, because I've been overseas and they take a 2-hour smoke break, and I don't want to have your hard-earned money into those companies that don't prioritize growth as much as we do here domestically. And so we're going to definitely keep our international exposure in check. The next thing I want to show you is the history of small companies, large companies, as well as medium-sized companies. And you can see very visually here that medium and small companies have outperformed large companies. Yet sadly, when I meet with new families, what seems like a daily basis, they have too much exposure to large growth companies. And it's sad because there are so many great companies out there that they could be investing in that adds more diversification, which means it doesn't lower your return, but it does lower your potential risk. And so this is why you'll see in our portfolios during the good times when mid-cap and small companies are having their heydays, and even when they're not, we're going to keep this a part of our recipe because we know the long-term performance. Now, lately, mid-cap is doing fantastic. And I think a lot of the reason for that is, as you know, small companies are trying to prove their concept. They're still a very large company, but they're not as capitalized. They don't have enough money to get out into the marketplace, as well as a mid-cap who's got the proof of concept. They now have the funding. But what's different between the medium-sized company and the small company is obviously they can pivot. While the large company who's trying to add AI tools is taking their time, and they're a juggernaut, so it takes them time to make those changes rapidly. Now, this is the dawn of trillion-dollar companies. It's pretty neat to be alive to see trillion-dollar companies and more being added probably in the next year with Taiwan Semiconductor, Eli Lilly, and Broadcom, just to name a few that are on the cusp of being trillion-dollar companies. And it's just I guess a microcosm of what's happening with inflation. You're going to see elevated company values, but also you're seeing this AI phenomenon, which has really pushed these companies up into their trillion-dollar status. Which leads me to what is driving the market behavior. If we lift up the economic hood, if we pay attention to the dashboard, and we really focus on the facts, this is what drives our economy. And if you've been to any of our State of the Markets halftime report, you've probably seen these red lights, yellow lights, and green lights before. Remember that red lights are those headwinds that we're going up against that are really slowing down economic performance. We have those green lights that are tailwinds pushing us forward, and then we have the yield that is caution, the area with the yellow. The couple things that I want to highlight for you is first is housing. If you have a child, a grandchild, I'm not telling you anything that you don't know. It's hard in housing right now for young and upcoming home buyers. But what we see is that new sales of homes has dipped. We've seen new housing starts drop nearly in half. in some permitting offices, and we're seeing days on the market also stretch out longer. So we're seeing these elevated pricing, but because of interest rates being so high, some of these new borrowers can't buy their house. Now, there's reasons to debate why the housing affordability is such a mess. I would like to argue that people are not saving enough. That's, I know, a little harsh to say, but it is the truth. People are not saving enough. So they're wondering how they buy a bigger house, and which leads me to my second point. They're oftentimes buying too big of a house compared to the same house that you grew up in is completely different. So that's the first item. The other thing we're keeping a close eye on is the end consumer, which we're going to talk about on the next slide. The negative, obviously, are these two red ones. We should be praying for world peace every day because geopolitical events have taken its toll on the market over the last 2 or 3 years. And it hasn't gotten any better over the last week either. With equity market valuation, that is something we've talked ad nauseum already about. It's something that, again, the market can only go so much higher until we are in a irrational, exuberant period of the .com kind of situation. So if we look at the end consumer, remember that 70 to 75% of the economy is driven by what the end consumer does. And if you look at consumers' disposable income, you look at our savings rates, what happened? We can see this, and we talked about it over the last 3 or 4 years. And this is no surprise because we told you and foreshadowed this would probably happen. We saw an artificial increase in savings rates during COVID. We saw that savings rates went up to 6%. And I said, that's probably because the end consumer is not spending money. They're not traveling. They're holding back, but they're getting helicopter money coming in that they didn't earn, and that this pent-up demand would finally release. And that's what we've seen. That's what's been driving the economy. Well, those dollars have been extinguished and instead have been replaced by inflationary pricing, which is why you're seeing the average savings rate drop till the 4 to 5% range that we find ourselves in today, which is very scary because if you have a grandchild, you have a child, you need to instill to them that 20% is their goal in saving for retirement. And I hate to use that word saving. It really should be investing for retirement. We are becoming a pensionless society. Social Security is not adequately funded. So that means all of the responsibility is going to be on your kids and your grandchildren's shoulders. So it's important to give them the financial education, send them to us, and we'll be happy to tell them what they sadly won't listen to their parents about. And that is saving more and spending less. But this is a concern because what will happen is if this savings rate continues to drop, and we're already seeing credit delinquencies and credit card balances starting to rise, which means that the end consumer is stubborn. They're the last to know that they're falling right off a cliff with their spending habits, and how sad that it could take a toll on the economy because that's what's driving it. This is a very fascinating chart, and to me it's something that we have to keep a close eye on as well. This shows you the S&P 500. So if you see it right here, so you see the S&P 500 and you see the Magnificent Seven. The Magnificent Seven, right here with the green, consists of those major companies like NVIDIA, Google, Amazon, those technological companies that are riding this AI phenomenon. If the market is up 14% and you strip out those Magnificent Seven companies, the S&P 500 is only up like 5%. So think about that. 7 companies are driving 9% of the entire 500 companies of the S&P 500. And we talked about this at the State of the Market, that nearly half of the S&P 500 companies are not even profitable. And so that is a reason for concern, because if we don't see, after the Fed makes its potential cut, which we'll talk about, we don't see all these other companies following suit behind the bigger tech companies, then I'm afraid that we will have some sort of market correction. So let's take a look at that AI phenomenon. What you're seeing here is an investment from companies around the globe from all sizes investing heavily into AI. And I've not made my opinion kept in a box. I've shared with it openly to all of you in your reviews that I truly believe the AI phenomenon is just like the dot-com crash. It's just like if you go back to cars. Like, yes, every one of those major technological innovations have impacted markets in a big way, but it always takes longer for it to occur and to seep in. And that's what I think will take place. I really believe that AI will be that platform for robotics, just like, again, you saw Microsoft being the platform for the PC. And that's what you'll see with Amazon with 800,000 robots now working. Imagine plugging in AI. That's going to sadly take away a lot of jobs, which I'm going to talk about. But you're seeing 180 billion dollars or something, big number invested globally in AI. So big investments there. Let's talk about inflation. This is on everybody's mind. When we're meeting with clients, there's two topics on mostly every client's mind, and this is one of them. So what we've seen here, and you can see the various factors of inflation, what makes up inflation, we saw that energy was a big driving force. That subsided a little bit, and we're seeing inflation starting to come down. But this is what we talked about in previous State of the Markets and halftime reports over the last 2 or 3 years. And I was very clear that this will be sticky inflation, that this will not be transitory inflation, that inflation is the new normal, the cost that you're paying right now, and that it would slowly permeate into the rest of the economy and sadly become solid. And that's what you're seeing with auto insurance. That's a prime example with auto insurance and home insurance, where the repairs on a home, the replacement of a home, obviously has to be factored into the new auto insurance, new home insurance. And with the climate, that's not helping either. And so that's why you're seeing your pocketbook be affected because of what happened 3 years ago. And so sadly, this is going to be the new normal. We're probably not going to see a deflationary event, which is not ideal anyway. We have to be careful what we wish for. So inflation now has permeated through the economy, and that leads us soon to talk about the Fed. So what may lie ahead? I always put this chart up here, and for good reason. These are some of the smartest minds in the world. They're paid 7 figures to actually make a forecast about what lies ahead in the next 6 months to 12 months of the economy. These are supposed to be the best financial minds we have, and they are so wrong all the time. And so that should give you confidence. When someone at the water cooler, the subject matter expert, Joe at the water cooler, has an opinion, you should just go somewhere mentally, because that person doesn't know what's going on. The news has to report news. That's their business. So they're going to, of course, talk about where they think the market is headed. But these are the best minds we have, and they're usually in the same pack together. And we can see here that Citi and JP Morgan have stepped away from the pack, and they have actually reported very bearish estimates for where the S&P 500 could end. While you got on the opposite spectrum, I think it was Wells Fargo, that is very optimistic. So my opinion, I stick with what I said in January, that I do think we're going to have a strong year, that we will start to have hiccups either with geopolitical events or a market that has tired itself out from escalating. And then that probably after the election, something could occur. One of those shoes could drop. But that's all speculation. Again, I have no clue, just like these minds right here. I do want to talk about what lies ahead, and this will be a big market driver, is AI. As you can see, these are the different industries that are affected by AI and how they think they will be affected by AI. And we talked about this in January, how AI went for the most wild segment of the population that I never estimated, and many people didn't either. It went for the creative jobs, which was really surprising. Now, what we're seeing here is at the top, you see IT. So I think it's just desserts. You created AI and it takes your job. Congrats. So that is where it's going to affect. But we're already implementing AI in our business with AI algorithms actually recording our visits that we have with clients because it actually produces the homework and homework for the client and homework for the firm. And that's sent automatically to the team. And so technology, if utilized in the right way, will actually push all of these boats up with the tide. But sadly, like capitalism, it always creates roadkill. And AI sadly will create a lot. And there's a lot of positives and negatives with AI. And I truly do believe that it'll be a positive event for everyone. I truly try to stay optimistic. But you can see what jobs and careers it's going for. If it were me telling my grandchild, you might want to be an irrigation installer because that's probably one of the last jobs they go for. So again, I say that now, but who knows with that Tesla robot. So continuing on, I want to give you a peek into the conference room when I sit down with a lot of new families lately. A lot of new families, when I ask them what they think a reasonable return is, what they think a loss that they could stomach would be, I'm hearing a lot of, I want to make a 10 to 12% return, and I don't want to lose more than about 15% of my money. And in my head, I think, well, let's look at some quantitative models. This is a great visual. This is done by Vanguard, one of the largest custodians in the world, and they're showing the performance of the various different indexes and portfolios that you could put together. So you can see here that they're actually estimating that international will have a larger growth pattern in the future. And that's probably because of those PE ratios that I talked about earlier, that international is really been discounted and that it has a lot of headroom to grow. But again, these are just quantitative models. And I put this slide up to just, again, take our expectations down a notch. The market historically is made, depending on the decade, 10 to 12%. But you have to stomach a 30 to 40% loss if you're going to experience that kind of return. Now, if you're thinking what I'm thinking, if I'm retired, no thank you. I don't want a 20, 30, 40% loss on my money. And this is why it's so important to have a written down financial plan like y'all do. When you have a financial plan, we're making sure that there's not too much allocated to those roof accounts where if you did lose 20, 30, 40%, it would not upset the apple cart. And that's why getting with us 1 to 4 times a year is so critical to make sure that those allocations between roof walls and foundation are correct. I'd be remiss if I didn't talk about the U.S. debt. It is a problem. And I know everyone wants lower taxes. I assure you I want lower taxes. But if we don't start dealing with government spending, we're at unprecedented times in government debt. Like I told you at the State of the Market, I believe that we're at the same peak as we were after World War II. And so if you see this pattern that we continue forward, we already have a significant amount of federal debt that is owed to other countries. That does put our, I would like to say, national security at risk when we have other countries that own our debt. And so that is not a trend we want to continue on. You do not want to see the government continuing to strong-arm banks to buy their own treasury bonds. That is not a good sign. Let's talk about the Fed. The market had priced in 6 rate cuts. They were very optimistic. They were very hopeful. And again, you heard it here at the State of the Market where I said that is not going to happen. That's very optimistic, but it shouldn't happen. And I've been very adamant, and it's very controversial, but I don't think the market needed 6 rate cuts. I don't think the economy needed to lower the interest rates too quickly because we do not need a resurgence of inflation. We need to dry it out, stop giving more water to inflation and let it dry up. And if we didn't, it would come back like mold, like mildew does. And so we needed to let it stay higher for longer. And I understand where the Fed is. They're really in a catch-22. They don't want to look like they have any political persuasion. So they're not in a rush to do a rate cut, but they're also keeping close eyes on the job numbers. And you saw that drop yesterday. But again, that's one number. And so I think it was a little premature for people to think that that's a good time to sell off a bunch of stocks because one number in jobs goes the other way. They don't want it to. So this is the second thing on everyone's mind. This is the drum roll slide. Everyone is talking about it. Everyone's thinking about it. Now, this is a controversial stance, but I'll tell you that it doesn't matter what side of the aisle you are, that elections do not make an economy. And luckily so, we have a bigger, more resilient economy than one person. What does make an economy is bad policy decisions over a 4-year period. And again, you can debate me, ideally not openly right here, but the energy policy in the United States is terrible. And we have experienced the last 4 years of a terrible energy policy. What we need from both aisles is a vision of where we need to head. What that will be, again, it's above my pay grade. Maybe that's nuclear power, maybe that's solar, maybe that is a combination of all of them. But not to have an energy policy is one example of many of bad policy mistakes that add up. However, you can see here, these are the facts. If we strip all the emotional angst, all my passion about, and make it gray for a second, what you can see here is that the market marches on no matter who is in office, and which is very comforting. And that's how it should be. An economy should be bigger than its one leader. So, most important part. This is what you should be the most concerned about, because you and I cannot control the greater economy, but we can control our personal economy. And that's what we're working alongside every single one of you on a one-on-one basis to make sure for your family, we're getting prepared for good times ahead with the economy and, of course, some bad times that will come. And so these are some of the strategies we've implemented for your family and are going to continue. The first one is rebalancing. It's age-old for a reason. It's one of the very few free lunches in finance that we have. And it's so important for many ways. I'll just give you 3. The first reason is when you rebalance, you're basically selling the winners to buy those underperformers. We have great recipes that make up our SWAN portfolios that are proven, that are back-tested, but they need to be that we need to adhere to them. And if we let emotion sadly say, no, let that winner win for a little longer, I think it's got a chance to grow faster and longer, then we're not being true to our investment statement policy. And so this is why we have an investment policy, because we stick to the plan. There are fire exits in every direction of this auditorium for good reason, because when you get irrational, you need to look for the fire plan. You need to look to a plan, and that's what an investment policy statement is. So we're sticking to that. Number 2, it frees up cash. If you're taking income from your investments, this applies to you. When we rebalance, we're getting that cash back into the portfolio to redistribute that to you. So rebalancing, a very important thing that we do for clients within our SWAN portfolios that we're actively managing on your behalf. I want to give a hand clap to Lucas. I'm very appreciative of him at the helm of portfolio management, because he's made some really good rebalancing that we've done, such as changing the maturity of our bonds. We felt that the interest rates had started to top out, and they finally are starting to top up. Again, what we're thinking, we're at the top and the peak, and if the Fed does cut interest rates, that will play really well for our changes that we've rebalanced to, because then the bonds will grow in value along with their yield. The second thing is we made a shift towards mid-cap value and value equities. So many times we'll pivot between growth and value, and we did just that. And that is already paying off in dividends, because value companies have strong dividends. They have that ability to weather a little bit more economic uncertainty than growth does. So rebalancing, a major strategy. The next is tax diversification. I'm happy to report to each and every single one of you, based on your situation, we've helped clients move 10, 20, 30, even 40% of their net worth to tax-free investments. If you're worried about the national debt, you're worried about where tax rates are headed in this country, the best thing you can do is take action. And what we've helped clients do is shift over to tax-free investments like their Roth TSP, Roth 401k, their Roth IRA, their life insurance, their municipal bonds, their HSAs. We've been able to migrate to tax-free investments so that when tax rates sadly potentially go up, then we'll be ready for it. It's, again, no matter where you are on the political aisle, it's very clear. There's administration sees taxes differently. It's been very clear that Kamala and that administration does want the Trump tax cuts to expire in 2026. And Trump, if he can or if he can't, that's a different question, wants to continue those tax rates being lower. If that does happen, that gives us a longer runway for each and every one of you to do those Roth conversions and Roth migrations that we've been helping you through. So again, I hope that tax rates stay lower, but again, something has to be done with the national debt and something has to be done with government spending. This is a big one. Over the last 10 to 12 weeks, I'm proud to report you've seen the changes we've been making on behalf in your email box, that we've been making changes to your portfolio. And that doesn't cost you any money when we make those changes, but I'm happy to report that for most clients, we've been able to downshift an entire 1 year for nearly every client. And so if you remember, we have 4 gears that we manage for our clients in those roof accounts, and those Swan Aggressive over to my left right here is where we actually put our entire 401k for the entire Swan Capital team. So we have skin in the game. We're investing right alongside you. And so a Swan Aggressive, we've been downshifting to Swan Growth, which has less risk. And then for some of you, we've downshifted you from Swan Growth to Swan Dividend. And all of that is in preparation for a potential pullback that could happen. Because anytime we would have a pullback in Swan Aggressive, like a major 2008, you could lose as much as 40%. So for some of your money, that makes some sense, but for a lot of you, that doesn't make sense. And so that's why we've been making tactical downshifting to get ahead of that. If you're taking income in retirement, you probably hear a lot of things, a lot of rules of thumbs that people use. They say, well, if you just take 4% off of your investments, you'll never run out of money. These are all just that. They're rules of thumb. You would not measure a house in 2024 by using your elbow to your index finger. That would not be the best way to do the measurements for building your house. And it's the same approach that you don't want to take into retirement. So this is why we're doing Monte Carlo simulations. We can, at your next review, do a maximum spend calculation to tell you how much that you can spend without running out of money. And we really want to get that up to a 98% of the probability that you will not run out of money. And so these are just what JP Morgan has put out with a 40% equity, 60% bond mix, how fast a retirement can be spent down. And this is why it's important that if your income needs change, that in a review, you let us know so that we take advantage of those Monte Carlo simulations and retirement income planning. This is an important slide. We had this at the State of the Market. We'll show it again because it is so powerful. The institutional investors such as CalPERS, which is handling California's retirement. If you look at the Sovereign Wealth Fund of the Cherokee Indians, if you look at the Endowment of Yale, they manage money utilizing what we call alternatives. And I wanted to show you on the far left, you see 80, let's see if I can put a little highlight right here. So 20% in bonds. That shows you how much volatility, how much risk that portfolio is taking, and it right here. And then it shows you what kind of return you can expect with a 9% return. That is the traditional way of investing, where we're just going to put your money in stocks and bonds. But if you are an accredited investor, meaning you have $1 million net worth excluding your home, or you have $2.1 million, that considers you a qualified client, which allows you to invest in alternative investments. And I want to show you why integrating 30% alternatives can be so valuable. What this analysis showed from JP Morgan is 50%, 20% bonds, and 30% alts actually had a fair amount of volatility lower than this 80-20 portfolio, but it also had a higher return, which is just incredible. So again, that doesn't apply to every single one of you, but this is why at Reviews we're talking about integrating alternatives like Signet. And remember that Signet is our real estate fund that invests in storage units, apartment complexes, short-term rentals, and flex industrial. One thing that I'm going to give you a little peek behind the curtain of what we're working on at the portfolio management team right now is one more new alternative proprietary fund. So we have Signet, which we're very proud of the dividend that's increasing over time, but we're also looking at energy. And here's why. AI is going to require energy. Robotics is going to require energy. And I don't think people are talking about this enough. If AI and robotics are a trend that you think are going to continue to grow, what is the force that sustains that is energy. And so that's why we're looking at the Swan Nest Fund that we're building out as we speak, that will have things like oil, notes, private credit, anything that spits out income, which is what our clients are looking for. In retirement, it's nice to have cash flow and dividends, which help us than just being consistently invested in just the stock market with stocks and bonds like that. Speaking of Signet, I want to show you one of the properties we've just recently invested. We invest in a vintage format, and what that means is that we buy 30 to 40 properties on a yearly basis. So we actually bottle those properties up. They start spitting out dividends for a 3 to 5 year period until they're ultimately sold. And so in 2029, we've actually bought some properties in Tallahassee, we bought a property in Charlotte, and we bought a property in Dallas. So Lucas, can you help me out with playing that video? This just give you an idea. So I share that video with you for two reasons. The first reason is if you're already invested in Signet, I want to show you some of the properties that were purchased already for you that we're in the process of renovating as we speak. But also for the 2029 vintage that we're actually adding clients' funds to right now. This is an example property that we're investing in. So I want to show you that if again, you don't already have those alternatives a part of your portfolio, but you're eligible, we do want to integrate that and kind of give you a heads up, a foreshadowing of talking about Swan Nest in the future. I don't want to watch that again. Okay, let's see if I press that again. Had a good jam though. So here's what actions you can take. This is the homework section of this presentation. It's really nice to hear me talk about all of these figures, but how do we take action in our personal economy? Well, the first way you can do that is when the market is reaching 31 all-time highs. This is the time to say, as a family, All right, let's look around the corner. Is there any renovations that we need to do now? Is there any purchases, big time purchases for a home, an RV that we need to allocate for now? Because this is the time where we want to start putting some money in stocks, our money market that's earning roughly around 5% these days, and push that aside while the market is doing well to get prepared for a big purchase before we have any pullbacks in the market. The second is QCDs, qualified charitable distributions. If you're planning on doing any end of year giving and you're over the age of 70 and a half, you can give up to $100,000 a year from your IRA and pay nothing in taxes. And so that's called a QCD, and what greater time to give to a charity while the market is doing well. Next is Roth conversions. This is a good time as we get closer to end of year to make sure that you've met with me and the team about getting your Roth conversions done for the year. We just need to know all of the income sources that you've had. We need the gross numbers to calculate that and help you alongside your CPA or ours. And then next is account contributions. Even if you're working part-time, and I may not know about it, but if you're working part-time and you're making $4,000 a year, that's great. I need to know about it because we may be able to do Roth contributions even in retirement. And so we can add more to a retirement account before the end of the year. And then 401k allocations for you that are still working and maybe you're 3 years out from retirement and you have the ability to make some 401k allocations. If you haven't already sent us your 401k allocations, it's a great time to say, hey, do I need to rebalance? Because those are outside of our peripheral, so we can't see them on a daily basis. If you have to file your taxes in October because you're waiting for a K-1 and you haven't met with someone like Rhonda or your CPA, again, those K-1s for Signet were a little behind just because of one major company that may not get any future investment because of it, because they've really taken their time with the K-1. But we're just waiting on one K-1 and we're hoping to get that done in the month of August. Again, these are some of the main figures that you might want to be aware of. The Roth contribution now is up to $8,000 per year per person. And as you can see, 401k contributions have increased as well. So these are some really important 2024 figures that we can get you actually a tax document that shows these updated figures. If you email us, we can email you a elongated version of this. Schedule your meeting with Rhonda if you want to do any end of year tax planning at our office. Scott has something to share with you. That handsome guy. That is so funny. Yeah, who's counting? There we go. So with this first bullet item, if you have a home that is not paid for, we used to tell clients that you want to be aware of doing any life estates. Enhanced life estates are basically adding beneficiaries to your home, and that could have messed with your mortgage, made it potentially foreclosable, and we didn't want any of that to happen for any clients. But Scott has been meeting with clients, and they've been meeting with their mortgage company to add that life estate to it, and many mortgage companies have no problem with that. And so this would be a great topic. If your home is not currently owned by a trust or not already has a life estate on it, then you might want to chat with Scott. Remember that a home is a probatable asset typically after the last spouse passes away, and you do not want your home to go through 11 to 16 months in Baldwin County, Escambia County, Santa Rosa in their court system. And so feel free to call Scott and have a conference call with him or chat with him about that. If you have legal documents that maybe you've had a major life change, but you haven't updated them, you haven't reviewed them, Scott would be happy to meet with you. Any things you want to mention, Scott?
Yeah, just like I said, I always tell people your statement is not stagnant. If your life events do change, things in your life change over the course of 30 years. They don't, I mean, congratulations. But most people's life changes in 30 years. So make sure that your wishes are as up to date as what the current situation is. If it's not, you can call. I'd be happy to discuss it with you. Also, Andrew kind of mentioned about the enhanced life estate. We want to talk about that. Even if you do have a mortgage, we can set up a conversation to have to discuss, making sure that you can have that conversation with your mortgage company and ensure that we can create those kinds of beneficiary designations on your real property to kind of get your your exposure to probate as little as possible.
Yep, so that is a complimentary visit. Scott would be happy to chat with you to make sure that none of your assets go through probate, talk to you about that life estate, make sure that your documents are up to date. If you feel like there's life changes that have happened or it's been over 5 years since you've reviewed your legal documents. Oh, I'm always scared to open this up. All right, it's scary. So if you would mind